Let's talk about the state of the market. And the state of the market is going to apply for both practice exit transitions and also your investments. I'm not an economist, but I've studied intensely the market cycles since going back to the late 70s and early 80s. I've been involved in 5 major market cycles since that period of time when I first started my investment and my professional career. So I've looked at it intensely, and what I know is that we've got both market cycles, business cycles that traditionally run every 6 to 8 years. That's average, which means some can be shorter and some can be longer. This last market cycle, we came out of the 2008 Great Financial Crisis. Out of 2008, 9, 10, started to pick up some steam in 2011, 2012, and started the rebound back to what we call a bull or an up market, really pretty strongly about 2012 and going forward. Running all the way pretty strong to the end of 2019, then the Federal Reserve tried to reduce some of their monetary stimulation and found that didn't work, so they kicked it back up again and we rolled into 2020. We were still probably looking at a correction or some level of recession in 2020, but of course we had the COVID Black Swan pandemic, which caused the Congress and the Federal Reserve to open the floodgates to stimulus money and expanding credit like we've never seen before. You'll understand that. PPP loans, helicopter money, wide open, and caused the inflation rate to increase like we haven't seen in 40 years. Everybody thought, well, not everybody, but the Federal Reserve and administration said, don't worry, it's just transitory, things will get back to normal soon, and of course that hasn't happened. And now they're seeing the results of really out of control fiscal and monetary policy. And there's really, I don't see any end to it. The end will have to come in some major reset, major economic reset, which I'm not even going to predict when, how that looks like. That's going way out on the end and probably nothing that we need to deal with right now, right here. Let's just understand that the world as we've known it in the past, certainly the past decade, and I'd say going back to 1980, which is when I really got out of school and was getting started in my career and starting to buy real estate. We started back then coming out of a period of what was called stagflation in the 70s. From really about 1965 to about 1982, the stock market, the financial market, was basically flat. Didn't do anything. That's stagflation. That means high inflation, anemic growth. Stock market equities don't do well during stagflation. To get the inflation under control, it took a federal chairman named Paul Volcker, who had a mandate back then to actually bring inflation down. The sentiment was there. The politicians' political sentiment, Jimmy Carter, Ronald Reagan, under which he served, both were pushing for getting inflation under control. And he did that by raising interest rates, not just a little bit, but substantially, over 20%. We couldn't do that today. No Paul Volcker could do that today. Why? Because of the massive debt that we have today. He was able to do it because our debt was relatively much less than it is today as a nation. Do that today and the wheels would come off of everything. So that's where our Federal Reserve is today, trying to play games and manipulate the interest rates and the Treasury with the currency and back and forth. And then we still have on the other side opposing stimulus coming from the government and Congress, which are spending like drunken sailors. We have the highest spending, highest deficit spending that we've ever had in a non-war period of time or non-recession period. I mean, everybody said we're in proxy wars, but we're not in all-out wars. And certainly everybody in the media and the government is saying, hey, the economy's strong. Well, the unemployment rate's really low. It's strong. It's strong. Why are we spending so much money? All right, you get my sense. I'm very much a cynic and very skeptical of the government and the media. And I think we have to look very much behind the curtain to understand what's going on. If we just take what's put out there in the press and the media, who are really, I think, in collusion with the mandates of the overall Congress and the administration, which I don't see that there's really any difference between left and right much anymore. They're all just big spenders and all wanting to hold their own. We have to take this into account. We can gripe about it. I can complain about it. I can be cynical about it, but that doesn't help. I have to say what is, and it's not going to be the same as I said what we've seen before. 1980, starting with interest rates as high as 20%, we had 40 years of basically falling interest rates. Not straight line down, but overall falling all the way down to next to zero in the summer of 2021. And that's when in 2022, early 2022, with inflation starting to ramp up and stay hot and heavy, then the Federal Reserve started ramping up interest rates and raised them 500 basis points, 500% over the next, 18 months. And we're sitting here today in 2024, second quarter 2024, with still the games going back and forth. Well, will the Fed cut rates? Will they not? And right now they're saying we're going to hold steady for now, which is not what the market thought they were going to do back in December. I don't believe the Federal Reserve, whether they cut interest rates or not this year, is going to have any effect on the overall long game. Cutting short-term interest rates, which is what the Fed can do, or raise short-term interest rates, certainly has an effect on demand. Businesses, as we know, contract, lay off employees. There's no expansion. People can't borrow to build houses or buy houses, or that's what they do. But most of the interest rates that affect our economy and affect us as business owners and our investments, most of those are based on long-term rates, which would be starting with 5-year, but more like 10-year, and on out to 30-year, which is the typical mortgage that we get for a principal residence. So it's the long end of what they call the curve that really matters, and the Federal Reserve doesn't control that. You might ask, well, who does? The market. Yeah, actually the market controls that. The Fed has no control over that. The market, which is global, not just U.S., but the global markets, the bond market, is huge, way bigger than the stock market, and that's what controls really the long end of the curve or interest rates. And as the bond market understands that getting inflation, quote, under control is something that the Federal Reserve is either going to do and go hard, or if they go soft, then that means inflation is going to rise back up again, and the bond market's going to say, not going to put up with that, rates are going to have to go higher. Well, just think about it. If you felt like inflation was going to stay higher for longer, would you accept a return today of 5%, and would you hold that 5% return for 10, 15, 20, 30 years? Would you be willing to do that? I wouldn't. Because if inflation runs at or higher than that 5% return, I'm losing money every day. I'm losing purchasing power every day. So the bond market will decide what they think the real inflation rate is, and they're going to push for higher. Well, what does that do? Well, that continues to hurt the economy and hurt our U.S. economy for sure, because we got so much debt, $35 trillion of debt, and we have to pay interest on that. Yeah, we, the taxpayers, we're the ones that pay the interest on that. So that sucks a lot of money out of the private market, our marketplace, where we do business, and the public market, the government market, sucks it away because from causing us to pay more tax and just a sluggish stagflation environment, where there's little or no growth, is just a deflationary effect for a while. So short term meaning maybe over the next year, and really in some of the more tangible asset markets, that would be real estate, that would be in businesses. I think those values, as interest rates have to stay higher to fight inflation, those values will come down to some degree. Now, every asset class and every market is going to be different. So I'm generalizing here, but saying real estate, asset class by asset class and region by region, they're all different. But overall, there's going to be a deflationary aspect to the tangible assets. And I'll get more to that and how it's going to involve practice or business sales. In terms of real estate, I think housing is much more stable overall than commercial real estate. Still, there's going to be certain markets where the bubble went too high too fast. Those markets, we're going to see a regression to the mean, coming back down closer to where the average over a period of time has been. That's regression to the mean. So the commercial markets, office, we already see what's happened to office because of the work from home. Remote workers, office buildings all across the country are selling for fractions of what they sold for just a few years ago. Then we get into more commercial, like multifamily, and you could go self-storage, retail centers. They're all going to have some downside correction. And again, we'll go deeper into this as we go through the weeks ahead. Then how do we know, and where can we invest our money? Where should we invest our money to have the best chance of maintaining principal and still getting a decent return? I mean, that's what we have to do as investors. We have to mitigate risk, but also we have to get a return overall that's going to be above the inflation rate. Because if we're not doing that, then we're losing purchasing power. So we've got to invest, but we've got to invest prudently and understand we're in a market cycle that's changing. So we talked about what I call a 40-year cycle from 1980 to, say, 2021, that 41-year period. That's what we call a secular cycle, big, long cycle. In between, as I said, we have market cycles, which are usually 6 to 8 years on average. But this last one that I think we're really in the correction mode right now, starting it, went from, call it 2012, all the way through 2022. 2023 had a big spurt. It's certainly in the financial markets. Real estate's already been showing some of the softness in some of the asset classes. Why? Because real estate or businesses, being tangible assets, don't ride the same emotional roller coaster that the financial markets do. Financial markets, you click a mouse. Very emotional. High-speed trading, computers. The sentiment of the economy from one week to the next, whether the CPI print is high or low, or the Fed indicates they're either going to hold rates or reduce rates, you see that market just spike all over the place. That's how financial markets work. Doesn't mean you shouldn't invest in the financial markets. You just have to understand that they're more volatile. If you're interested in learning how to invest safely and profitably during any economy, any market cycle, whether it's up, down, good or bad, then just download my free report, the Full Cycle Investing Report, below. There's been a lot of past cycle investors who have profited immensely, made great gains in the last 15 years during the bull market we've had. However, the markets are changing. They always do. There's going to be a day of reckoning. You can either be prepared, take advantage of the opportunities and protect your wealth, or put your head in the sand and do like so many other people, wonder what happened. If you'd like to be on the front edge of the things that are coming in the future, just download my free report, the Full Cycle Investing Report, in the description below. In tangible assets, there's more time to watch, see, adjust, and that's really why I like to invest more in tangible assets. They're more inefficient, which means as a retail consumer investor, as I am and as you are, much more opportunity. But there's work to be done. You can't just click a mouse. You have to have education, knowledge. Access is a big one. Access, and I don't mean illegal access on the stock market, financial markets. Inside information, of course, is illegal. In the tangible alternative space, not illegal at all, because it's hard to get the information. Every market's local. To get information and to find opportunities to invest, it takes a network. It takes relationships. And that's something I built over many, many years of my life, and it paid off immensely. And what we do in Freedom Founders today is I bring all those relationships, to the forefront and give, access, and really what I call fold time, collapse time. Speed to goal is what we're all about. So in your life, whenever you need to get something done, learn something faster, what did you do? Well, when you're younger, typically you just have to work it out. Today you could go on and learn stuff on YouTube, I guess. That's one way to do it. You could get learn some trades and some skill sets and learn how to do Excel and things. A lot of things you can learn on your own today because the information is available everywhere. But what if you want to really shorten that curve of learning? Well, you go to people or places which have a history of folding or collapsing time to get you to your goal. Whatever you want to learn, whatever you need to know, whatever access you need, you go there and you buy back your time by taking money that you've worked hard for, and you buy back time. When we're young, we don't have the money, so we have to expend our time to get the money, and then later on in life, we should be able to turn that money back into time. That's the whole goal. So, back to the state of the market. I believe that we are at the tipping point of, a downward correction. It may get pushed off till after the election. They still can pull a lot of rabbits out of the hat. I'm talking about the Fed and Federal Reserve and monetary policy, and Congress and the administration will, I think, continue to spend like crazy. Our deficit I think we're adding $1 trillion every 90 days right now to our national debt. And that doesn't even include the unfunded liabilities of Social Security, Medicare, other entitlement spending. It's off the charts. And I don't mean to come across as a pessimistic ogre. I'm just realistic. And I want you to be also, because we have to look through a lens of reality. In doing that, we can make much better decisions on our career paths, our businesses, our business operations, when we sell our businesses, and certainly into the investments we go into. Because particularly when we cross the line from active income, where we can always go back to work and fight another day and make some money to provide for our families and pay bills and whatnot. Once we cross the line, we're actually basically saying, I'm out. I'm totally out of active income. I'm not going to make any more active income unless I just choose to go volunteer or do something for fun. Now we've got to make that nest egg work for us. It becomes so important at that point. No matter where you are in your age, you've got to make that work. And it's, in my opinion, going to be much tougher to do that because we're not going to have the stability of the markets that we kind of got used to over many, many years. Index investing, just put it in the market, just dollar cost average, just write it out. Don't think that's going to pay off like it has in the past. I think this is going to have to be much more direct management of your assets, whether you like stocks or bonds or mutual funds. I mean, I'm not saying don't do it. If that's your area, then you're just going to need to be more on the forefront, in my opinion. You need to learn more about what you're doing and not just hand it off to a third-party financial advisor. Most of the financial advisors today are relatively new to the game. Well, just see what their age is. Many of them are younger than 30 years old, 35 years old, 40. If you're not working with somebody who's at least 60, high 60s, 66 to 70 or more, they hadn't been through the full cycle. Most of them have been in an up market only. They have no idea what to do in a corrective market. They're going to give you advice based on recency bias, what they've seen in the past. Trust me, they are not getting the education and not with the gray-haired people that if they spent time with them would help teach them. They're all out there feeling like they're geniuses in their own right because they've had the benefit of the tailwinds of the economy and the cheap interest rates, low interest rates that we've had for so many years, which has caused the bubbles everywhere. Those bubbles are going to come down because interest rates are not going to come down, and the Federal Reserve cannot continue to pump more stimulus, more credit expansion, because the more they do that, the more we have a problem with the dollar staying strong enough to be the reserve currency. We already have countries today, the BRICS nations, who are doing workarounds around using the dollar. It's coming. Not going to say it's going to happen tomorrow, next year. It's going to be over a period of time. But again, I think in 5-10 years, the global economy is going to be different than it is today. And the U.S. is not going to have that superpower ability to kind of own the markets like we have. Having the reserve currency, being the dollar, has been the ticket for our government and our representatives to be so fiscally and monetarily irresponsible. That's been their ticket. And it's going to get taken away. And when it does, all bets are off. So, disinflation, some correction, maybe some deflation in some assets. I think the stock market, financial market, equities in the stock market, when they drop, when the trigger hits, I think we're due for a substantial correction. We're not there yet. We're seeing the volatility. We're seeing the flux. It's coming. Again, may not happen before the election because they'll do everything they can to stoke it up and keep things up till the election. After the election, don't hold your breath. So if you make it there, you've got to be thinking about, do I want to stay there? Or do you want to take some risk off the table? We'll talk about more tactically how I believe you can do that. And again, I don't give financial advice. I'm not a financial advisor. I'm just going to tell you what I've seen, what I've done. My circles of influence are a lot of people that are very, very wise in the economy and the markets. I spend a lot of time there. And I've, of course, done my own research and have my own investments, primarily in alternatives for now 44, going on 45 years. So I've ridden these market cycles. I have at least an inherent strong understanding of what they look like. But again, this is a discussion for us to have. So correction in the financial markets, it's coming. I've talked about the fact that real estate is also going to go through some correction. I'm not going to talk much about crypto. I think it's speculative. If you want to play some in the crypto space, have at it. I think that should be money that you're willing to lose. If you make some great gains, awesome. You get to brag about it at your next dinner party. But we're going to focus on really what I call being a good investor going forward with this. That's about as deep as I want to go into this state of the market because there's so many more nuances to go down, and I could talk forever. And my point is I want to keep these relatively shorter videos, but this one's important. See you on the next video.